Bank of America reporting a third quarter beat on the top and bottom lines and a 43% surge in investment banking revenue. Joining us now in a CNBC exclusive, Bank of America CEO and Chair Brian Moynihan. Brian, good to see you. So let's start there on that investment banking revenue, up 43% during the quarter. Huge growth, or huge driver of growth. What do you attribute that to exactly, and how would you characterize the pipeline on a go-forward basis?
So, Les, it's good to see you again. Number one, attribute to winning with our customers. We have customers from large multinationals through middle market clients in the firm, tens of thousands of them, and we work hard with them to win their business, and the team under Matthew Coder did a good job of winning that business. So it was a good quarter, the highest non-pandemic related quarter we've had, and across all the regions and across all the different types of revenue, we felt very good about it. The pipeline is full. Our customers are active. They're looking at deals, and the momentum has been building for a good while here. And I think now with the probability of deals getting done, the financing markets generally open, we feel very good about the pipeline.
Yeah, I was going to ask you about the financing markets, especially as we look ahead to the potential for lower interest rates. Your net interest income up 9%, beating analyst estimates, and that's thanks in part to loan and deposit growth. How do you expect that to look as those rates do decline? Do you expect that to continue to improve?
Yeah, it will continue to grow. The interesting thing is our growth rate is, be about 5 or 6%. This 25 over 24, and we told people this morning that we expect that trend to continue. A part of that growth is loan and deposit growth. A part of that growth is also the repricing of balance sheet. And even if you, as we disclosed, with a significant reduction in rates beyond what the market expects, which is a reduction in rates already, you would still grow NII year to year. And so the team's done a great job of building loans and deposits, and that's compounding in. We had strong loan growth in our wealth management business this quarter, $12 billion of quarter-end loan growth in a quarter, which is pretty good. And the team's done a good job on the commercial side and the market side, lending to the formers of securitizations, mortgage companies and stuff. It's all in pretty good shape, and we feel very good about that NII. Continue to grow this quarter and beyond into 26 and beyond 26.
Yeah, I want to drill into the commercial side and ask you more about credit quality. I know that Bank of America was part of the syndicated loans for First Brands and reserved for that exposure during the quarter. There is some broader concern as to whether First Brands and Tricolor, those were two auto bankruptcies, are basically the canary in the coal mine, and whether there could be cracks forming across the system. I know you did actually take provisions down during the quarter, so you obviously feel pretty good about your own book. But I'm curious, what is your view on just industry-wide based on what you're seeing?
So I think, just to be specific, our net non-performing loans went down on the commercial side quarter to quarter. Our criticized loans went down, and the credit quality has been improving. And the commercial charge-offs, which we would have talked about a couple years ago a lot, have been coming down. So let's back up. In the regulated banking industry, remember that there's multiple ways that we not only feel we do a good job at credit ourselves, but we can see across the industry. The CCAR test, the stress test just came out, and you can see the results across 30 companies that we give them the data, the Fed looks at it, and you might assume that the Fed is never looking at it to say, oh, let's take it easy on them. They do a rigorous analysis, and you've seen the loss rates we're the lowest among the peers, but they're all low, and that's good credit quality. And then secondly, in our industry, you have shared national credit examinations and things that go on continuously, especially among the larger banks where groups of examiners come and look at it. So outside verification, and then internally, all of us have stuck to an idea that we have to pick customers well and grow the business well. That doesn't mean there won't be charge-offs on occasion, or you're not taking enough risk. And so what we see right now in our book of business, both on the consumer and the commercial side, is a loss rate in the 40 basis points, which is similar to what it was in 19, which was a 50-year low for our company. And so this is strong credit quality. It's examined by third parties. We look at it hard. We have thousands of people in credit administration and the credit things that look at it hard. We look at every deal. When a deal goes up in the market, we actually look around and say, is there anything that we could see? And so we feel very good about our credit quality. But I think for the investors out there, for the regulated banking sector, there's extreme reviews of their portfolios as part of all the regulatory process. But half the asset classes of all different asset classes are outside the banking system, so that's a different question.
Yeah, so that was my follow-up question there, was whether you think there is more culpability or more risk, I should say, within the non-bank financial institution area, and whether you see any risk for the traditional banking system lending to non-banks, and what could happen there, especially if there is some sort of serious downturn.
When we lend to those companies, we take highly secured positions, meaning the non-financial institutions, on pools of assets, and we look underneath them. So the commercial loans, we look at the loans and say we come to an independent assessment. So I think, and our peers do likewise. So I think we feel very good about what we do into that industry. I think you have an industry which has grown a lot, and we'll see what happens as it matures. But that, I think, is a better question for someone else, because as we lend to that industry, we take that into account. But there's a lot of participants we don't do business with I could reflect on.